Hello and welcome to CFA Institute C-Suite Talks. My name is Paul Kovarsky, Director of Institutional Partnerships, here to talk about the subject of geopolitics. It's a topic that is on a lot of people's mind, especially so right now. Here, we're privileged to be talking to one of the experts, Taimur Hyat, Chief Operating Officer of PGIM in investment management of Prudential Financial, manages $1.2 trillion. Taimur oversees as well as operations, strategy, and solutions for PGIM. Taimur, welcome. I'd like to ask you a first question to follow up on the discussion we had roughly 6 months ago on the risks of geopolitics in investments. Brexit and Europe has moved on with it and stand on the cusp of large changes. Has the landscape been permanently reshaped?
I think the landscape has been permanently reshaped, and our report foreshadowed things that have only exacerbated, particularly in Europe since we last chatted about this. And I think, if anything, political risk in developed markets has become even more central to the analysis that our investors and our portfolio managers need to do to understand the true long-term potential in any asset that they look at, whether it's fixed income, equities, or real estate.
Well, staying with the theme of Europe, and you mentioned a couple of prominent countries, one of the challenges people have is getting grip on their exposure. So you quite often have a country with a predominance of employees in one country, shareholders in another, customers in a third, and regulators in Brussels. How should the investment organizations think about tracking the exposure and mapping it to the various risks?
Well, this all became very real with Brexit, when we had investors scrambling to understand their true exposure to the UK and their true exposure to Europe. I mean, you have the MSCI Europe Index, where over 50% of your exposure is actually not to Europe. And similarly with UK. And it wasn't just direct equity. This is what's happening within debt. It's what's our real estate exposure. And it was very hard for investors to figure out what their true exposure was to Brexit. And I think that was the wake-up call in terms of these complex relationships you mentioned between what is my true exposure to our country. And we would urge all investors to spend much more time than they currently are spending, really trying to unravel what are the first and second order effects that truly result in the exposure to a particular trend or a particular country. And I think one of the key things investors can do here is actually work with companies to really improve their disclosures. It's really hard to unravel the supply chain, the vendors, the debtors of a company and understand what is the true exposure of a company. Maybe headquartered in Germany or headquartered in Seattle, but what is the true underlying client base and vendor set that is creating real exposures for this company? And I think investors can play a key role in really accelerating that exposure of that information and getting more transparency around that.
Just pulling on that thread of disclosure, what are the best practices you're seeing out there as to how investment organizations can actually work with the CEOs of those companies that are producing the information for the analysts and so forth?
I think there are two pieces here. One, I think investors can really encourage companies around the world to give much more detailed exposure around what their country risks are in terms of not just their client base, but also where their vendors are, where their debtors are, what are the other indirect exposures that they have. And I think the second key thing for investors to do, or for their third-party managers, is really to make political risk analysts and political risk analysis integral to how they think about an investment decision. None of the old levels change. You still have to see what does pricing look like, where in the market cycle you are, what are the macroeconomic indicators. But another equally important dimension that's now been added even to G8 investments is what's the political risk analysis?
Staying with the theme of political risk analysis, the end goal, if you like, I understand, is to spot tail risks and those kind of events that are incredibly hard to forecast but incredibly influential.
Of course.
And with that, are there any particular areas around the globe that you're watching for any catalysts, any signs of those tail risks emerging?
Well, first of all, you're absolutely right. The sort of classic VAR-based models that you had for looking at kind of asset pricing risk really don't work with political risks. A lot of the key political risks are tail risks, and they are pretty binary. Do India and Pakistan go to nuclear war or not? What happens in the North Korean-US negotiations? What happens in the South China Seas? These are binary outcomes, and your classic risk-based models, which economists are used to, really don't work that well in this setting. So I think tail risk analysis and scenario analysis and gaming out different scenarios and seeing what does that mean for my portfolio and understanding what it means for my exposures is pretty critical in this setting. I think in terms of tail risk that we see, clearly some of the tensions in South Asia would be one. I think what happens in China, not necessarily a tail risk, because we do think that it'll return to maybe not the almost 10% type growth rates, but they will definitely have higher growth rates than developed markets. But the speed of the slowdown, whether there's a risk from kind of corporate leverage there to have some kind of economic shock that the government and macro policy can't fix quickly enough. I just think the behavior of politicians around the world and what kind of trade or other risks come from that, all those are risks we are looking at. So I think it's not one big tail risk. It's lots of politically driven risks that will add up and accumulate and exacerbate each other in ways that the markets are feeling very vulnerable to right now.
Let's give CIOs there some tools. What should they be doing, looking at their portfolio, looking at their exposures? And as you are answering that question, could you possibly distinguish between those that are in the regions undergoing change, such as EU, or those that are a little bit in different markets, such as US, but still obviously need to have exposure to that important region?
Yeah, I think a few things. CIOs, first of all, should continue to invest globally, but think regionally and really think about what are the political risks in different countries and gather all the third-party sources that give a pretty rich account of what's happening in different countries. Second, these third-party sources, while valuable, are mostly backward-looking. We would really encourage CIOs to talk either to their third-party asset managers or in-house teams that look at political risk and analyze that with a forward-looking view, what's coming next. And third, I think CIOs need to spend much more time in data analytics and understand their true exposures by unraveling behind the headline headquarters of a company what is the true set of country exposures that they have.
Very interesting. We spent quite a bit of time on developed markets, which is the new home of geopolitical risk, but one should always be mindful that emerging markets, whether on their own, as you mentioned in India and Pakistan, or as a feedback loop from developed markets, can also be prone to arguably larger movements. How do you think about that?
I think EM political risk has not gone away at all. It's really that the developed markets have caught up with EMs rather than that EM political risk has changed. It's high. And I think some of the nationalistic movements that we talked about in our paper, The End of Sovereignty, have also extended into EMs perhaps in a deeper way than 6 months ago. I'm thinking of Brazil, for example, and some of the discussions in Mexico. I think what the key thing in EMs that's really changed that CIOs need to take account of is that emerging markets aren't really a monolith. So when you look at risk in Turkey or Argentina, it really doesn't bear much weight in what's happening in, for example, in Indonesia or Vietnam. And China, of course, is an entity unto itself, with its own influence. But thinking about emerging markets as separate countries and their separate trajectories, and increasingly their domestic demand-driven growth engines, whether it's the middle class or EM to EM trade, that is what's become critical there.
Taimur Hyat, this has been really useful and for sure discussion, packed of interesting highlights and actionable advice. Thank you very much on behalf of CFA Institute. Hope to talk to you soon.
Thank you very much.